Welcome to this crucial technical masterclass designed for serious investors, optimizing the Sharpe ratio in volatile markets. We are not here to talk about generic stock picking. We are here to discuss rigorous, quantitative wealth preservation. The Sharpe ratio, as you know, measures the excess return per unit of total risk. In today's highly unpredictable market landscape, simply chasing returns is a recipe for catastrophic drawdown. Our goal over the next 10 minutes is to systematically increase that ratio by attacking both the numerator, excess returns, and crucially, decreasing the denominator, standard deviation. We'll start by establishing the macro context, analyzing the delta between current asset valuations and their long-term historical averages. This divergence is where risk is truly priced, and understanding it is the essential first step before any capital allocation decisions are made. Prepare to look at volatility not as a danger, but as a pricing inefficiency to exploit systematically.
Before we dive into tactics, we must quantify our starting position by analyzing the quantitative delta between current valuations and historical averages. This involves running regression analysis on assets, such as analyzing the cyclically adjusted price-to-earnings ratio, or CAPE, relative to its 25-year mean. When the current CAPE ratio is 2 standard deviations above its mean, the probabilistic odds of mean reversion increase dramatically, signaling higher embedded risk. This analysis isn't speculative. It grounds our strategy in objective data. We use this data to calculate the expected risk premium required to justify holding certain assets. If the expected excess return doesn't cover the measured historical standard deviation, the asset is mathematically dilutive to your overall Sharpe ratio. Understanding this relationship between valuation extremes and the math of compounding is the psychological discipline required to hold through inevitable drawdowns, because you know your entry point was mathematically sound. The primary macro driver of today's market structure is the correlation between fiscal policy and asset inflation. We must trace the movement of the M2 money supply. Rapid increases in M2, often fueled by large government stimulus packages or quantitative easing, create an abundance of liquidity that first drives up risk assets like technology stocks and real estate, leading to inflationary regimes. However, the subsequent tightening, or quantitative tightening, acts as a brake, directly increasing the cost of capital and putting pressure on highly leveraged companies. This cyclical dance between expansionary and contractionary policy directly influences asset correlation matrices. We are specifically looking at current M2 money supply trends and what their deceleration signals for the next fiscal quarter, often a rotation away from highly growth-dependent assets towards assets with robust free cash flow and strong pricing power. This macroeconomic overlay informs all subsequent decisions regarding risk exposure. Institutional desks, particularly those managing large endowments and pensions, rely on sophisticated risk mitigation techniques beyond simple diversification. One key strategy is dynamic hedging, where they use derivatives like options and futures to actively manage delta exposure in real time, rather than simply accepting beta risk. Another critical technique is liquidity segmentation. They divide the portfolio into high liquidity buckets for immediate risk needs and lower liquidity buckets for true long-term compounding. Specifically, in times of high volatility, they increase the weight of assets with low historical correlation to the main equity benchmark, which smooths out the overall portfolio standard deviation. This often involves strategies that profit from volatility itself, such as volatility arbitrage or specific tail risk hedging instruments. The goal is to build an all-weather portfolio, where performance is less dependent on a single directional market move, thereby stabilizing that Sharpe denominator even when the market is experiencing intense selling pressure. A highly effective method for structurally improving the Sharpe ratio is the strategic introduction of truly uncorrelated assets into the mix. Remember, the power of diversification isn't just owning many different things, it's owning things that behave differently under the same macro conditions. We're talking about assets with near zero or even slightly negative correlation to the S&P 500. Examples include sophisticated managed future strategies, catastrophe bonds, or specialized commodities that respond to distinct supply-demand pressures rather than equity valuations. When you combine assets where one performs strongly when the other is down, the overall portfolio standard deviation, the denominator of the Sharpe ratio, is dramatically reduced.
This effect is mathematically powerful. Reducing risk exposure while maintaining the same return generates a superior risk-adjusted outcome. It moves you from an efficient frontier on a traditional equity line to a higher, more stable efficient frontier, fundamentally changing your portfolio's profile during turbulent periods.
Let's shift now to our 12 actionable tips, starting with the analytical foundations. Tip number 1, analyze historical compound annual growth rate, or CAGR, over at least 3 full market cycles, ideally 15 to 20 years. Short-term performance metrics are prone to recency bias. Long-term CAGR provides the true compounding power of an asset, filtering out noise. Tip number 2 directly addresses the macro environment. Assess the specific impact of interest rate hikes on your asset valuation. Highly discounted future cash flows, typical of long-duration growth stocks, are brutally repriced when the risk-free rate rises, as the discount factor becomes much larger. Conversely, assets with immediate cash flow generation and low debt tend to fare better. You must model the sensitivity of your asset's intrinsic value to a 100 basis point move in the benchmark rate. If the sensitivity is too high, you're carrying unnecessary duration risk that will erode your Sharpe ratio when the central bank is tightening policy. Executing discipline is critical, focusing on tips 3, 4, and 5. Tip 3 requires you to implement a rigid portfolio rebalancing schedule. Quarterly or annually is typical. Rebalancing is your mechanism to systematically sell high and buy low, forcing you to trim positions that have become overweight due to performance and reinvesting into those that are currently depressed. Tip 4 addresses the long-term drag. Evaluate the management expense ratios, or MER, for every investment. Even a seemingly small 1% MER annually can represent a substantial 20% drain on your total capital over 30 years, significantly diminishing the numerator of your Sharpe ratio. Tip 5 is key to risk management. Examine the standard deviation of your holdings to fully understand potential drawdowns. The 12-month standard deviation provides an expectation of volatility. If the standard deviation is 20%, you should psychologically and financially prepare for at least a 20% drop in a typical adverse year. Knowing this prevents panic selling. Moving deeper into valuation and hedging with tips 6 and 7. Tip 6 demands rigor. Use a discounted cash flow, or DCF model, for intrinsic value estimation. This anchors your purchase price to the actual calculated worth of the business, independent of market mania. Ensure your DCF uses conservative projections and a realistic weighted average cost of capital, or WACC. By buying assets only when they trade at a significant margin of safety below their calculated intrinsic value, you inherently build in capital protection against volatility. Tip 7 focuses on structural risk. Diversify across geographical jurisdictions to hedge sovereign risk. Relying solely on one country exposes you to specific political, regulatory, and currency risks. By having exposure to markets with non-correlated political cycles, you reduce the systemic risk embedded in your portfolio, stabilizing your returns regardless of domestic turmoil. This proactive hedging against geopolitical instability is a hallmark of sophisticated risk management. Tips 8, 9, and 10 guide us through macro timing and efficiency. Tip 8, monitor the yield curve inversion. A sustained inversion, particularly the 10-year minus 2-year spread, has historically been one of the most reliable indicators of broader economic slowdowns, providing essential context for macro timing. While it doesn't predict the exact date of a downturn, it mandates a shift toward defensive positioning. Tip 9. Prioritize assets with strong pricing power in inflationary regimes. Look for companies that can raise prices without significantly impacting demand. Think monopolies, mission-critical technology, or strong brands. Their ability to pass costs through preserves margins, which protects earnings during inflation. Finally, tip 10. Leverage tax-advantaged accounts for high-turnover strategies. Tax drag is an often underestimated cost. By executing high-frequency trades or rebalancing within retirement accounts or specialized tax shelters, you ensure that realized gains are maximized, which directly feeds into a higher overall post-tax Sharpe ratio. The final 2 tips address the critical behavioral element, psychological discipline. Tip 11 is perhaps the most important for long-term survival. Establish an investment policy statement, or IPS, to prevent FOMO.
Your IPS is a written contract with yourself, outlining your goals, risk tolerance, asset allocation ranges, and rebalancing rules. When the market surges and FOMO hits, you refer to the IPS, which acts as a logical firewall against emotion. This structure prevents impulsive buying at market peaks. Tip 12 deals with the inverse. Review your exit strategy during periods of extreme market greed. Greed, defined by metrics like low VIX readings or record-high sentiment indices, signals peak euphoria. Use this time not to buy, but to review your initial investment thesis. If the intrinsic value has been met or exceeded and the risk-reward profile is skewed, stick to your written exit strategy. This counterintuitive discipline ensures profits are locked in, safeguarding the cumulative returns and preventing the massive volatility spike that accompanies market tops.
Let's ground these principles in a practical case study. We examined a model portfolio utilizing these 12 principles during the highly challenging 2022-2024 transition, a period defined by rapid rate hikes and geopolitical instability. While the broader equity market saw a 15% increase in realized volatility, a massive jump in the Sharpe denominator, this model portfolio successfully maintained a calculated Sharpe ratio of 1.2. The average institutional hedge fund often struggles to maintain a Sharpe above 0.8 during such periods. How was this achieved? By rigorously focusing on intrinsic value via Tip 6, avoiding overvalued growth stocks, and significantly limiting exposure to long-duration bonds. Furthermore, the active diversification via Tip 7 and the psychological adherence to the IPS via Tip 11 meant that the overall drawdown was limited to just 8%, compared to the 22% experienced by the benchmark index. This case study confirms that applying these quantitative disciplines leads directly to superior risk-adjusted outcomes, proving that protecting capital against large drawdowns is the fastest way to compound wealth.
In summary, optimizing the Sharpe ratio in a volatile world is about mastering quantitative analysis, understanding macroeconomic forces, and maintaining unflinching psychological discipline. We covered everything from dissecting the delta between valuations and historical averages to implementing granular strategies like DCF modeling, tax-efficient rebalancing, and establishing your investment policy statement. Remember, wealth preservation is not about avoiding risk entirely. It's about being compensated appropriately for the risk you take. Always focus on increasing the return above the risk-free rate while aggressively minimizing the standard deviation of your portfolio. If you found this technical breakdown valuable and plan to implement these 12 pillars, please signal that support. Don't forget to like and subscribe for more updates and in-depth quantitative content delivered weekly. Now, a final essential note: comprehensive disclosure. This material is strictly for educational purposes. Investment inherently involves risk of loss. Always consult a certified financial professional or registered fiduciary before making any investment decisions or taking specific actions based on this material. Thank you for joining the masterclass.